Global markets over the last few weeks, you might have felt something shifting, something subtle at first, but then it started getting louder. Bond markets suddenly became jittery. Yields spiked. Analysts began using words they normally avoid: meltdown, contagion, liquidity crisis. But today, that quiet background noise turned into a global alarm. Because Japan, yes, Japan, the country long known for its stability, its discipline, its calm financial behavior, just triggered a shock that is now rippling across every major bond market in the world. This is not speculation. This is happening in real time. And if you understand how global debt works, then you understand why experts are calling this the most dangerous moment in decades. Let's break down exactly what happened. Japan's bond market was never supposed to break, but it just did. For more than 30 years, Japan held the reputation of having the world's most stable bond market. The Bank of Japan kept interest rates near zero, or even negative, for years. The government kept borrowing, relying on the fact that investors felt safe buying Japanese bonds. It became one of the core pillars of the global financial system. Japan's debt-to-GDP ratio is the highest in the developed world, over 230%. And yet, nothing ever happened. The system kept going, until now. In the last few days, Japanese government bond, JGB, yields, especially the 10-year benchmark, spiked to their highest levels since 2008. Think about that. A country that has been artificially holding rates down for decades suddenly saw its bond yields jump like a pressure cooker releasing steam. Traders immediately noticed something unusual. The sell-off wasn't coming from foreign speculators. It was coming from inside Japan. Domestic banks, domestic insurers, domestic funds, the same institutions that always supported the government's debt, are now stepping back. Here is where the story becomes truly global. Japan is not just another country with a lot of debt. Japan is the world's largest creditor. Japanese institutional investors, pension funds, banks, insurance giants, hold over $12 trillion worth of assets globally. That includes U.S. treasuries, European bonds, corporate debt, emerging market debt. If Japanese yields rise enough, these investors will start pulling money back home. Not because they want to, but because they will be forced to. Their domestic portfolios need rebalancing. Their regulators will pressure them to stabilize Japanese markets. This means trillions of dollars could suddenly start flowing out of global markets and back into Japan. The volatility index jumped. It took only minutes. That is how interconnected the system is. Japan moved, and the world trembled. What triggered this? A massive gamble by Japan's new leadership. Prime Minister Sanai Takaichi announced a huge fiscal expansion plan. More borrowing, more spending, more aggressive government intervention. In a normal environment, maybe this wouldn't panic investors. But right now, the timing is catastrophic. Japan is trying to issue even more bonds. At the exact moment when demand for those bonds is collapsing, recent auctions for 20, 30, and 40-year JGBs saw historically low demand. It is simple economics. When supply goes up, but demand collapses, yields explode higher. And in a country with 1,300 trillion yen in debt, rising yields can quickly become deadly. The Bank of Japan is signaling it won't rescue the market the way it used to. For the first time in decades, the Japanese government is facing the bond market alone. The contagion spread instantly. When Japan's yields spiked, U.S. Treasury yields rose. Why? Because Japan is the single largest foreign holder of U.S. debt. If Japan pulls back even 5% of its holdings, it can destabilize the $27 trillion treasury market. Europe entered panic mode. Italy's borrowing costs jumped in minutes. France saw significant bond outflows. Germany's Bund yields rose. Europe is extremely sensitive to global financial shocks. And Japan just delivered a massive one. The World Bank and IMF are already issuing warnings. They see synchronized debt distress. Financial analysts are calling this one of the most dangerous debt moments of the century. Japan's crisis didn't come from one source. It came from three sources striking at the same time. 1. Inflation returned. After 40 years of deflation, inflation is back and sticky. This forced the BOJ to tighten policy. 2. Aging population. Japan's population is shrinking faster than any major country. Pension funds have higher liabilities and fewer workers. Savings pools are shrinking. 3. Policy shock. The new fiscal expansion was gasoline poured on a burning market. This combination creates a vicious cycle. Higher yields mean higher borrowing costs. Higher costs mean larger deficits. Larger deficits mean more bond issuance. More issuance pushes yields even higher. And then comes the worst part. The carry trade unwind. For 20 years, traders use the yen carry trade. Borrow money in Japan at near zero interest. Invested in high-yield countries, US, India, Brazil. Pocket the difference. This flow of cheap money supported US stocks, crypto, and emerging markets. But when Japan's rates rise, the carry trade unwinds violently. Traders must buy back yen, sell foreign assets, reduce risk, unwind leverage. This creates global selling pressure. Tech stocks dipped. Emerging markets weakened. Crypto saw volatility. This is the true global contagion. Japan sneezes, and the world catches pneumonia. So here's the final question. If this was the warning shot, what does the real crisis look like? A $12 trillion repositioning doesn't happen quietly. It doesn't happen without consequences. Japan has already forced global yields higher. It has shaken liquidity worldwide. Japan was the quiet backbone of global debt, the one country everyone thought would stay stable forever. But the moment Japanese yields spiked, the world realized a brutal truth. If Japan can lose control of its debt, then no nation is safe. The world appears to be changing, and those who see it coming will be the ones who survive. In chaos theory, they say a butterfly flapping its wings in Tokyo can cause a hurricane in New York. Well, the butterfly has just flapped its wings, and the hurricane is already forming on the horizon. This isn't about fear. It is about clarity. The era of easy money and consequences-free debt is officially over. The bills are coming due. The window to prepare, to deleverage, to diversify into real assets, to understand the difference between value and price is closing. History doesn't wait for us to be ready. It just moves. The question isn't, will the system change? The question is, will you move with it? Or will you be left behind with the debts of the old world?